Hello guys, this is Rydon Academia. Today we'll be looking at the theoretical aspect of bank reconciliation statement. As you can see on your screen, a bank reconciliation statement can be defined as a statement prepared to reconcile the disagreement between the cash book balance and the bank statement balance. Okay, now when we prepare our cash book for companies that usually have a bank account, there's an aspect of their finance that they do keep in the bank. Okay, so for some reasons, if the bank statement and the cash book balance do not agree, which reasons we'll be discussing very like in this video, the company prepares a bank reconciliation statement with a view to reconcile the balance of the cash book and the balance of the bank statements. Okay, now the reconciliation is necessary in order to test the accuracy of the posting in the cash book. Alright, our reconciliation help us to know how accurate our posting is in the cash book. Okay, by reconciling the balance of the cash book with that of the bank statement. So we only know an accurate account when you can reconcile or bring your cash book balance to an agreement with that of your bank statement by checking out your posting and making necessary corrections. That's how we know if your cash book has been accurate in the posting or not. Alright, a bank statement, people may be asking, okay, what is a bank statement? Now a bank statement is a book which the bank prepares to show the transaction between it and the customers. Okay, the bank prepares this statement, people deposit money in the bank, people do a lot of things with the bank, so it is proper and wise that the bank keep record of these things for future references. Okay, so a bank statement is what the bank prepares to show record of the transaction between it and the customer. Alright, so as a matter of necessity, the balance of the cash book and the bank statement must be equal. Now I may not be treating cash book as a subtopic or explaining cash book in this video, but I hope to post a video on cash book for proper understanding even after we are through with this video, so you can just check out and see what the cash book look like and why a bank statement is being referred to in this case. Okay, now if you look at the screen, we'll be looking at some reasons for disagreement between the cash book balance and the bank statement balance. Okay, now there are various things that make our cash book and our bank statement not to agree. Yes, there are a lot of reasons, so today we'll be looking at a few of them. Okay, the first we are looking at is our unpresented checks. Now as you can see on your screen, these are checks drawn or issued out in favor of somebody. Okay, but they have not been drawn from the bank at the time of the preparation of the bank statement. Now I want to explain this in a more simpler way. I can say your unpresented check, they are the check the business issued to a customer. Okay, the business draw to a customer, maybe they were trying to settle a debt or pay a credit through bank. Okay, they drew a check for the customer, and then they have the business at that point we credit its cash book, we credit its cash book with that amount drawn on the check. But now the customer had not yet gone to the bank to cash out that check. You understand? They had not yet gone to receive that check. Alright, that's why you can see on your screen that they are drawn in favor of somebody but have not yet been withdrawn from the bank at the time of preparation of the bank statement. So the customer is yet to receive the money from the bank. That means the bank is not aware of that transaction. Therefore the bank statement balance will still be the same, whereas the cash book has been credited. Alright, so in that case the balance of the cash book and the balance of the bank statement will no longer agree, and the effect is that the balance of the cash book will be lesser because it has been credited. It will be lesser than the balance of the bank statement. So the correction as a customer, what you do is that you less the balance of the bank statement, you add unpresented checks back to your cash book balance. Okay, now our second reason why there's a disagreement between cash book and bank statement balance is the uncredited check. Now uncredited checks, they are checks received, alright, Like unpresented was issued out. Now we said uncredited was received. Alright, they were received and entered on the debit side of the cash book. Now the business received maybe from its debtors. They received check from their debtors. They have recorded it on their own credit side in their cash book. They have entered it on their debit side, sorry, because they were receiving, so it's a receipt. They have debited that entry in their cash book, but they have not yet gone to the bank to withdraw that money or to enter that amount in their bank statement. Therefore the bank is not aware of that transaction, okay, and therefore the balance of the cash book will be higher than the balance of the bank statement, you understand. In our unpresented check, it was the business that was giving out money, so the business was crediting its account, but in uncredited check the business was receiving the check, so it has debited its account, but now the business had failed to present this check to the bank for them to be credited properly, okay. So this is why the balance of the cash book will be more than the balance of the bank statement. So what we do when we receive our bank statement is that we less uncredited check from the balance of our cash book. Now the third reason is our dividends. This is a reason why bank statement and cash book also disagree. Okay, our dividend is part of the profit. It's a reward for shareholders, reward for shares. Okay, now when a business is holding shares in a company, the company usually work with their account. They don't really give them dividends in hand, okay, they transfer to their account. Now when these shares or this profit are transferred, they are transferred to the business bank's account, okay. The business may not necessarily be aware that they has received this money, and because they are not aware, they fail to debit their cash book, okay. They fail to debit their cash book with this entry, whereas the bank already credited their account. So with that having happened, the balance of the bank statement will be more, okay, than the balance of the cash book, because the bank statement had received an income, but it did not reflect in the cash book. So the correction after we receive our bank statement is that we add our dividends to the balance of our cash book. Do you understand? The next reason is our standing order. Now many businesses, when they have lots of activities or lot of payments to make, they usually inform the bank, okay. They can give the bank a command to make certain payments on their behalf, okay, maybe like the hire purchase installments, and some people may even add salary, okay, payment of salary. They may give the bank order to make that payment on their behalf on a regular interval. So it depends on the time. It can be weekly, quarterly, or yearly, as you see on your screen. So they give that order to the bank to make certain payment on their behalf. Now maybe a time may come and the business may forget to credit their own cash book, okay, whereas the bank already debited their account. So with that, the balance of the bank statement will now be lesser than that of the cash book. So what we do in correcting this is that we deduct standing order from the balance of our cash book. Alright. The next reason is our dishonored check. Now our dishonored checks are checks received from customers. This term is very related to our uncredited checks. Okay, they are checks received from customers and they are paid in by the firm. That is, the firm entered them on their debit side. But when the firm went to cash out or to withdraw this money from the bank rejected these checks because maybe there was a wrong signature, or the amount was incorrect, or the amount was more than the money in the account of the debtor, okay. So with all and other reasons, maybe the date was incorrect, something like that, and then the bank was not able to attend to that check. Alright, and that's what makes it a dishonored check, unlike our uncredited check that was not taken to the bank at all. Dishonored check was taken to the bank, but the bank rejected it as a result of several reasons you can see on your screen, okay. So that check will no longer reflect in our bank statement. And if the company, that is the business, does not credit that amount from their account. That means that at the end of the accounting period, the bank statement will be showing a balance that is lesser than the balance of the cash book, because the cash book already has a debit that wasn't reflected in the bank as a credit. Okay, so the balance of the bank statement will be lesser than that of the cash book. So what we do to correct that is that we less dishonor checks from the cash book balance. Now the next reason for disagreement is credit transfer. Now credit transfer are payments made by customers of the firm directly into their account. Alright, this is looking a bit similar to our dividend, but dividend are profits. Okay, they are profit as a result of share investment, but credit transfer, their money, their payments, maybe creditors, debtors. Okay, debtors pay directly into the customer's account without necessarily informing the business that they made such payments. Okay, so these payments were made and the bank received these payments and the bank has credited the business, but the business, being not aware, has not yet debited their cash book. Okay, so as a result of that, the balance of the bank statement will be more than the balance of the cash book, and in correcting that, our credit transfer should be added back to our cash book balance. Alright, we have bank charges and interest. Now our bank charges, they refer to the amount that the bank deducts, okay, for the services they render to the business, such as maintaining accounts, maybe transfer charges, or other, and then bank interest. Okay, now we start with bank charges. Bank charges are deduction. Okay, the bank reduce certain amount of money. Maybe there was a transfer, like I said earlier, was a transfer. The bank will reduce a percentage, and also at the end of the month, the bank reduce their charges for keeping your account. Okay, whereas bank interest are addition the bank give you for partnering or banking with them. Okay, so when bank charges are not they are many times the business are not aware of these bank charges, and therefore the balance of the cash book will be more than the balance of the bank statement. Okay, and therefore the cash book, for us to correct that error, the cash book has to be credited with the amount of the bank charge. Alright, we have direct debit. Now direct debit looks a bit similar to standing order. Alright, the direct debit is an arrangement made by let's say made by a creditor, that is one whom the company owes money. It's made by the creditor and the company. Okay, whereby the business account is debited with a sum of money at the instance of a supplier, that's our creditor. Okay, with the account owner's prior permission. That is not like a standing order where the company authorizes the bank. It's, in other words, like the company already are aware, they are aware of this. Maybe they went to take a loan, like that's, I think that's the best example I can think of. They went to take a loan, and as at the time due, the bank to which the loan was taken from automatically has access to take their money. Okay, even without their notice or without their awareness. So that's what it looks like. Not really like it was the company that gave the bank that authorization, but it was a binding law already. Okay, unlike our standing order. So but the company is not aware that such amount has been withdrawn. Okay, and that will now result in the cash book balance having a greater balance than the balance of our bank statement. So what the company must do is that we will reduce direct debit from our cash book balance. Now there are other errors by the bank. Okay, banks make mistakes like you see on your screen. Maybe we have errors of transposition, or errors of commission. Okay, or errors of original entry. There are a lot of errors. Okay, but the example that we gave on the board, on our screen, as you can see, is an error whereby the bank credited a different customer, okay, instead of the business. All right, so that That's an error of commission. The bank pays another customer instead of the business. Okay, so this mistake can also affect the balance of the cash book. Okay, and the balance of the cash book will now be lesser than the balance of the bank statement. Okay, now this other error is an undercasting or overcasting of the cash book balance. Undercasting meaning the amount was reduced, okay, maybe in a mistake, or usually it's a mistake. By mistake, the balance of the cash book was totaled wrongly, okay, and the wrong total was lesser than the original total. Okay, that's an undercasting. When we have overcasting, meaning it was totaled wrongly, or maybe and a transaction was entered wrongly, and the amount of that transaction is higher than it's supposed to be. Okay, this error also affect the balance of the cash book. Okay, now if you see there's an analysis chart, we're able to make this chart so that people will be able to understand what we have been explaining so far. Now you can see on your screen we have our causes of differences, and these differences have their effect on the cash book, and they also have their effect on the bank statement, and we have the way of correcting them when starting with a given balance, and the way of correcting when starting with the bank statement balance. In these two columns, you can see correction when starting with, it's supposed to be cash book balance, and then for the other one, correction when starting with our bank statement. Okay, it means there are two ways to prepare cash book. You can start with your cash book balance, you can start with your bank statement balance. So in uncredited check, the effect on the cash book is that you are having a greater balance, because already the business already debited themselves. Okay, but as at yet they have not yet presented that check to the bank, so the effect on the bank is that it will be having a lower balance. So when starting with our cash book balance, okay, we subtract uncredited check. But if you are starting with your bank statement balance, you'll be adding uncredited check. Now for unpresented check, as you can see on the board, we have explained this before, when the effect on the cash book is that it will be having a lower balance, because the business already credited themselves as they gave the check to a creditor. Okay, they already debited themselves, but that person was yet to withdraw from the bank, so the balance of the bank statement will be higher or greater. Okay, and then that of the cash book will be lesser. So in correcting that, when starting with cash book balance, we will add our unpresented check, but when starting with our bank statement balance, we subtract unpresented check. Now we have bank charges, and the effect on the cash book is that the cash book will be having a greater balance, because the bank charges had to be deducted from the bank, the amount in the bank. Okay, so the amount in the bank will be lesser, while that of the cash book will be greater. So when correcting that, starting with cash book balance, you will deduct, okay, you subtract bank charges, but when starting with bank statement balance, you will add bank charges. Alright, so on the screen I'll quickly run through them, and then we'll go to the practical aspect. We have our standing order. The effect on cash book is there's a greater balance. On the bank statement, there's a lower balance. When correcting, starting with your balance as per cash book, you subtract standing order. When starting with balance as per bank statement, you add standing order. Okay, now we have credit transfer. The cash book will be having a lower balance. So when starting with balance as per cash book, you add your credit transfer, and when starting with balance as per bank statement, you subtract your credit transfer. Okay, now we have dishonor check. Dishonor check will result in greater balance in the cash book, because already the business entered that amount on the debit side, but it was the bank that rejected that check. Okay, so the bank statement will be having a lower balance, and the way to correct that is that you subtract, when starting with your balance as per cash book, you subtract your dishonor check from your balance as per cash book. Meanwhile, when starting with your bank statement balance, you add dishonor checks, okay, to make it balance. Alright, so number 8 is our direct debit. Okay, now our direct debit, the effect on the cash book is that we'll be having a greater balance. Okay, since the supplier actually went to withdraw from the bank and not really from the customer in this case, the supplier went to withdraw from the bank, so the balance of the cash book will be greater than the balance of the bank statement. So in correcting that, when starting with our cash book balance, you subtract direct debit. Okay, but when starting with our bank statement, we add direct debit. Alright, so number 9, undercasting of receipt side of cash book. Now our receipt side talk about the debit side of our cash book. Like I said, I'll be doing a video to on cash book, so that for better explanation, I'll be doing a video for cash book after this video, so you can watch there and understand more about cash book. So our receipt side of the cash book talks about our debit side. Okay, now when the receipt side is undercast, meaning the total figure was wrongly calculated, so that the total figure is now lesser than it's supposed to be. Okay, it's lesser than it's supposed to be. That means the cash book will be having a lower balance than the bank statement balance. Okay, so when correcting, starting with balance as per cash book, we add the undercasted amount. Okay, we add it up to the cash book. But when starting with our bank statement balance, we subtract the undercasted amount. Okay, and the last one is overcasting of receipt side of cash book. Now, like we have undercasting, overcasting means there was a mistake in calculation, so that the total was now more than it is supposed to be. Okay, and this mistake is made by the business. That means the cash book balance will be greater than the balance of the bank statement. So when correcting that error, when starting with balance as per cash book, we will be subtracting the overcasted amount. But when starting with balance as per bank statement, we will be adding the undercasted amount, so that we will have a balanced account. So with this, I have come to the end of the theoretical aspect of bank reconciliation statement. The next thing we'll be doing now is our practical aspect. I'll be preparing accounts, showing you how to start with balance as per cash book, and also how to start with balance as per cash statement. So see you in our next video. Thank you.